morning, everybody. Mike Tedeschi, Wealth Management Advisor over at Perspective Wealth Planning with this week's in-depth market dive. As always, if you guys find this information useful, please subscribe to our channel so you can see this on a weekly basis. In this week's video, we are going to cover the four major U.S. indexes. We're going to take a look at oil. It was quite a week in that space. We're also going to take a look at the banking index as well as the transports and the emerging markets. So let's jump right into it here. When we left this off last week, we talked about this major resistance zone that goes back here over the last couple of years, and now the S&P had rallied right up to underneath of it. Since that point in time, we don't really have a change. We turned back down from that, bounced back up a little bit. And really, if we're looking at this here over the last couple of weeks, we have traded inside a very small range here in comparison to the move that we've had over the last couple of months. This is still a really decent sized range historically against what the S&P typically does in terms of volatility, which is still extremely high. But we have really traded in between that 2,700 and that 2,900 now for 2 weeks, and we have fluctuated right around the middle of that range the majority of the time, where almost every single day actually went up or below the middle of that range at some point. So really, we need to pay attention to this area for our next potential move. As we have said over and over again, if we get back up above this, we have the opportunity to rally continually higher. And if we stall out right here, this would be kind of that zone where we would kind of expect it historically, taking a look back at potential bear market false rallies, which typically tend to die in that 50 to 61.8 fib retrace level at a major resistance zone, and at about that 25 to 30% rally size, which is exactly kind of where we're at right here on the S&P 500. Now, what's very interesting to note here is this year, all right, this white line that I have here on the top, this is actually where we closed 2019. So this is the green line for the year 2020. And the Nasdaq traded positive here at the end of last week and the beginning of last week, i.e. it was up year to date. Now, it's the Nasdaq 100, not the Nasdaq Composite Index. So it's the 100 strongest names in the Nasdaq. And what's interesting to note, and we'll talk about how the majority of the wealth is actually concentrated in the top 5 stocks. In fact, 5 stocks make up 21% of the S&P 500 at this point in time, which is just a crazy overweight in the top names. In fact, it's higher than it was in the dot-com bubble, which was the highest that had ever been before that. What I have up on the chart here is the S&P 500 versus the S&P 500 equal weight divided by the market cap weight ratio. And what that is saying is the equal weight, every single name in the S&P 500 has equal weight to every other name, versus the a heavy weighting towards the bigger names being the cap weighted ratio. And what you can see here is the difference between that is very clear. And what that's saying is the large names are really what is holding up the indexes as wealth continues to be concentrated towards the top. And that's really, really displayed when we take a look at the chart of the Nasdaq that went green for the year. There are a number of names inside the Nasdaq, being tech, being able to work from home, and everybody ordering things delivered to their home, that really have done well during the current market environment. But again, that wealth has really been concentrated in a few names. And what we really want to see from markets to continue to have strength is we want to see that broad-based movement out of the majority of the stocks, not just a couple of behemoths at the top. So we're going to continue to watch the Nasdaq here as it oscillates above and below green for the year. But note, I mean, the major area of resistance in here on the Nasdaq is right in on this zone as well. So again, it's been the strongest by far this year. Again, we didn't even come close to getting back to 2018's lows when we had this sell-off right here. So the Nasdaq is clearly the leader, and we're going to continue to watch that for signs moving forward. The Dow, as we mentioned before as well, right, we really have that the lower end of the resistance zone, whereas the S&P is back up towards the top end of the resistance zone. So the Dow has been weaker this year. than the S&P 500 overall. But it is nothing compared to the weakness that we still see out of the Russell. The Russell is still below the 2018 lows. So remember, we just took a look at a chart of the Nasdaq. It didn't even get down to that level, and here we are with the Russell cleanly under it, and that bounce hasn't even gotten up to it. So even on this bounce, it's been weak. You would expect it at least to have gotten up and tested that zone, and it still, couldn't get up over 1250 there. So this is really, really important. And this will bring me into talking about the financial space. The Russell is mid small caps, and it has a heavy weighting towards actually regional banks. And when we look at the financial space, so here is the Nasdaq Bank Index that we have up on the screen. It is down at this point. At one point year to date, I think it hit 40%, 47% down, and right now it's sitting at about 40% down on the year, so exceedingly weak. And you can once again see lower than we were back in 2018, and it's very, very hard to see, really strong market strength for a long period of time without financials participating in that. And we've never had a bull market with financials not participating in it. So this, of course, continues to be an area of concern. And the other big area of concern is the transports, right? The transports are still well below that 2018 low. Again, how do we have a long-term strong market rally without goods moving through the economy? It's very, very difficult to do so. So when I take a look at what's going on underneath of the surface, I look at the fact that the weighting is so high on the top 5 names in the indexes. It makes me concerned for moving forward that this is and has been kind of that false bear market rally. But we do have unprecedented Fed and central bank action around the globe with lots of additional stimulus and money being pumped in here. So we could continue to see that disconnect for a while. Again, we've never had this much central banking intervention. So some of the historical metrics that we look at in the past may not hold as much value into the future because we've never had that happen before. Speaking of things that have never happened before, let's take a look at oil. All right, I'm going to pull up, first off, I'm going to pull up a 4-decade chart of crude oil prices here. And you can see on this chart, we got is down to $6.50. And that is the active contract for crude. When we take a look at crude and in commodity markets, there are contracts for delivery at certain months. And what I want to look at right here was what happened to the May month for oil. This was when it was no longer the active contract, meaning it had 5 days or less to trade on it, and everybody, the majority of people were trading on the June contract. The only people that were really holding onto this contract were people that were going to take physical delivery of crude oil in the month of May. And what happened is we essentially ran out of places to store oil. So people that were holding on to this contract, planning on taking physical delivery, started to realize that there was nowhere for them to actually put the oil that they had bought because all the storage facilities were full. And subsequently, what happened was there was nobody to buy this contract. And we went from Monday morning and opening at $18 a barrel to actually going negative. We went to negative $40 a barrel for the price of oil. Since there was nowhere to store the oil, there's no way to turn oil production off. That oil has to be delivered somewhere. The market was trying to find a price in which somebody would buy that oil, and buyers didn't step in until we got extremely negative. Now, in this particular case, there was just financial engineering in terms of this happened in the paper market. No actual physical oil was being traded at negative $40 a barrel. In fact, producers came out and said they wouldn't deliver oil for less than $10 a barrel. But it is conceivable that at some point in the future, physical barrels of oil will actually trade for a negative amount if demand continues to be virtually non-existent in comparison to the way things were a few months ago, and supply continues to pile up, and we don't get production cuts in a meaningful manner. We basically have run out of places to store the oil. So oil is no longer being an asset, could actually become a liability, which has never happened before. And again, that's why I started taking a look at a 40-year chart of crude oil, because for the last 4 decades, we have never had oil trade underneath of $9.75, and we did get down again on the active contract down to $6.50 this week, and on the contract for delivery in a few days, negative $40 a barrel. So this world is certainly a very bizarre one, to say the least. 2020 has had a lot of firsts. And we continue to look all around the globe at what is going on, and continue to see a lot of concerning signs, for sure. Next, I want to take a look at the emerging markets. Speaking of going around the globe, when we look at this on a year-to-date basis, the emerging markets are also exceedingly weak, and the price of oil being down certainly doesn't help them. From their high point of the year, they actually fell a little bit deeper than the S&P 500. Their rally has not been quite as strong. And if you look at that 2018 level, we're still underneath of it. So the emerging markets are still down here over the last couple of years. Or again, the major U.S. indexes are not, and the reason for that being, again, a few really, really strong names in that space. As we continue to move forward, we need to continue to pay attention to what is going on underneath the surface, and not just taking a look at the major indexes, the only thing that we pay attention to, because there are clues under the surface in terms of what has been leading and what that means moving forward as well, which I want to take a brief moment to talk about. This data here is up to the 19th of April. So it's a couple of days old when you're seeing this video. But from the bottom that we had back in late March, our leaders are actually energy, healthcare, utilities, materials, discretionary. That is not what you want to see from a sector standpoint in terms of leadership. Now, again, tech didn't fall as far, but it's lower down here, and it has gotten stronger over the last couple of days. But the point that I wanted to make from this is the leaders that we are seeing right here are not the leaders you would expect to see if we had put in an actual bottom when we take a look back at historical data points. You do not want to see utilities near the top of that list. That's a safety area of the market. So we want to continue to pay attention to what's going on underneath of the surface, because it can certainly give us a better clue as to what's going to happen moving forward. I hope you guys found this video useful. If you have any questions or comments or want to reach out to me directly, feel free to reach me at mtedeschi@perspectivewealthplanning.com, or you can pick up the phone and give me a call at 814-580-9881. I hope you guys have yourselves a fantastic week. As always, I'll see you guys next week. Stay safe.